Three stocks to buy near 52 weeks low. This is a video that I haven't done in a while, and I mainly review a lot of the stocks, very popular stocks you guys been asking me about, and they are trading at 52 weeks low. And it's not easy to find in this crazy market. Everything's at 52-week high. Everyone is a genius. Everyone's up 50-60% on the year. It's not easy to find good opportunities kind of undervalued at 52 weeks low. But I did my best. I selected three of those stocks. All of them are amazing quality, good companies, but they are trading at 52-week low. And in this video, we're gonna find out if any of those stocks are good buying opportunities. There's a few of them. Some of them are good buying opportunities, but some of them are a little bit expensive. And I'm gonna tell you where I believe they would be trading at fair value. And I mainly used Ticker, or I should say Finviz, as my screener. And I just put in stocks close to 52 weeks lows. They are profitable. And I just took out the materials and all that stuff. And I selected some decent companies that a lot of you like trading at 52-week low. So I really, really hope you enjoy it. The first one, which I got at least 200 questions on for the last 6 months, and this is Elf Beauty. Elf Beauty has been an amazing performer over the last 5 years. It's up around 600%, but from the all-time high, or you say 52-week high, it's down 43% and around 29% over the last 6 months. It's been struggling. A lot of you have been asking me if it's a good buying opportunity or not. And Elf Beauty, it's a company that a lot of you know, but a lot of you didn't know that company just a few years ago. In fiscal year 2022, they had a 6% market share in cosmetics. Now their market share is 12%. And what makes Elf Beauty stand out, you could say, and what's making them take competition from other players is they have some decent quality brands. They're not too bad. From what I heard from a lot of people, the quality of their brand isn't really trash. I mean, it's decent kind of quality, but it's a much lower price versus their competitors, which has been working very well over the last 2 years. We had higher inflation. People still want the skincare and other stuff they like. And that means they wanted something at a lower price. And Elf Beauty did fill up this need, and they did very well. And this is an amazing comparison where the prestige brands, they're selling it for 20, the masses, they're selling it for 9.5, and Elf Cosmetics is selling it for 650. And this is the power of Elf. And they had a lot of success. They had a lot of growth, not just in the United States, but internationally. International growth for them has been 91%. 91%. I mean, it's insane, absolutely crazy. And the growth has been good. Up to 71%, 50%, 40%. But now it's slowing down, and it's expected to be for the second half 16 to 20%. And this is what's really killing Elf. This is what's killing Celsius. This is what's killing, you could say, Enphase. This is what's killing a lot of the growth stocks. Because whenever you have a growth company that's priced to absolute perfection, you have a tiny drop in the growth. The company gets a little bit more, but once the growth starts going down, it's over. Like, your stock is gonna crash and the multiple is gonna contract, and it's really bad. The worst things that could happen for a growth company priced to perfection is if the growth starts declining a little bit. And this is what happened to Elf, 16 to 20%. It could be temporary. Maybe this is not gonna happen forever. But again, 16 to 20% isn't too bad. I mean, I don't know who expected Elf to keep growing, 70 and 80% forever. That was extremely unrealistic. But if you look at the multiple of Elf, it's trading at 30 times forward earnings. And if you look at it on a historical basis, 30 times forward isn't really too bad, because this is where the stock bottomed in 2022, around 30, 28 times. It was a good time to be buying Elf. Same thing happened in 2020, bottom 28, 30 times. It's been a good time to be buying Elf. And this is what's happening right now. But the only problem with this multiple is it's fooling a lot of people, because Elf isn't really trading at 30 times. And this is because of their massive stock-based compensation. And this is what you have to pay attention to with a lot of those companies. Stock-based compensation for them is huge. 40 million for fiscal year 2024, free cash flow was 62.5 million. This is massive stock-based compensation. And you could normally see the difference in the difference between GAAP and non-GAAP EPS. For 2025, which is what this 30 times earnings is based on, it's based on EPS normalized of 357. But if you look at the GAAP EPS, which does put up with stock-based compensation, is at 263. So ELF isn't really trading at 30 times, it's trading more like 44, 45 times earnings, which doesn't make it as cheap as it does appear on paper. But you have to know that it's not just ELF. Most of those growth companies, they have massive stock-based compensation expense, and Wall Street and the analysts, they tend to value them on non-GAAP EPS versus GAAP EPS. So this is what I'm gonna use to value ELF Beauty in this video. You look at what I put up. It's just very basic stuff. I put up the current earnings per share estimate of 357 that I put in for the next 5 years, and I put in a 20% gross CAGR over the next 5 years. And I think 20% is fair. This is what the analysts are expecting. It's not going to grow 97% forever. So I believe 20% is achievable. 20% should be fair for the company. And if we do that, we get $8.88 per share. Okay, now we take in the 888, and we did say that ELF is trading at 30 times non-GAAP. Now, assuming 5 years from now, the growth drops a little bit more, which I believe is very reasonable, we can assume that maybe ELF is going to trade at 25 times earnings, which is possible. And we put in 25 times, we time it by 25 times, we get a share price of $222 per share. The current price is 116. So if we divide it by $116 per share, we get pretty close to 91% on the upside over the next 5 years with ELF Beauty, which isn't really too bad at all. It's not bad at all. I think it's a good opportunity. But I have to say, for me personally, my original price on ELF was $85 per share. That's what I was telling a lot of people. Since it was trading at 150, people ask me about ELF, I tell them $85 per share. But I was somewhat impressed of the last quarter, and I believe around $100 per share offers a little bit more margin of safety, because now the growth is dropping. You don't know for how much it could drop. Maybe this is the bottom, maybe it's not the bottom, maybe the multiple contracts a little bit more, maybe and it's not too cheap on a GAAP basis, it's like 40 something. So it's not unreasonable to maybe even assume that ELF could trade at 20 times earnings 5 years from now. It's nothing crazy at all. So if it does happen, you want some margin of safety. So ELF here is not too bad. And I see 91% upside on, you could say, the best case scenario. But if I had to get some margin of safety, I would go for $100 per share or below. I think it's hard to get it wrong if you're buying ELF at $100 per share. And that was my quick analysis on ELF, and I'm trying to go very quickly. This is a quick overview. It's not a deep dive or anything. And the second one, that's a quality company trading at a 52-week low that a lot of you have been asking me about, is CNI, which is Canadian National Railway. It's been going down due to labor issues and different issues they've been facing. And it's trading at 52 weeks low. You compare it to US railroad companies, a lot of them are trading at 52-week high in this crazy market. And CNI does have a good network. It's not just in Canada, but it also goes into the United States. It goes into Memphis, Tennessee, and it goes into New Orleans. It goes into Chicago, Detroit, and in so many different places. And they do ship a lot of petroleum. 19% is petroleum chemicals, grain fertilizer, forest products, metals, and mining, and automotive, and coal, and many different things. And it's a well-known company. It's a very good network. Now, the only problem with CNI is it's not too cheap on a historical basis. So we look at, the mean PE ratio is 19.9, and now it's trading at 19.4. It did trade at 25 times in 2021, and I don't even know why, but 2021 was peak everything. So I would never assume that CNI is gonna get back to 25 times earnings. That would be too optimistic. But for me, around 19.4 times, I'm not seeing a room for a multiple expansion, which for me, it would mean that I would have to look at the expected earnings per share estimate and assume that the growth of CNI's share price will likely be close to the earnings per share estimate, assuming no multiple expansion or contraction. And this is around 12.5% over the next 2 years. And I don't know what's going to happen in 2027, 2028. No one really knows. But for the next 2 years, it's 12.5%. So I would assume CNI will likely return 12.5% to 13% annual return from here. And it's not really bad at all. But for me personally, I like buying stocks with a potential of a multiple expansion. I like buying them, somewhere below the mean. So if the mean for this one is 19.9, I would love to buy CNI around 18 times, 18 and a half, even 17 times. So 17, 18 times, I would still get to 12.5% potential earnings per share growth, a decent dividend, and I would get the potential of a multiple expansion, which could push my return to 14, 15%. So I like CNI over here. It's not too bad, but for me, I would put like a price alert and then wait for it to go to 18 times and buy it then. And that's what I would do. It's not the most exciting stock ever, I would say. And that's my review on CNI. The third one, which I got a lot of questions on, is VC Properties is down 4.6% on the month. A lot of you know the company. It's a very well-known company I used to talk about. And they own many iconic properties on Las Vegas Strip and even outside the Strip. But things like Caesar Palace, Park MGM, New York, Luxor, Mandalay Bay, MGM Grand, so many different, very Venetian, so many different properties they own. They aren't going anywhere. And it's a very safe company because they have over a 41 years of weighted average lease term. The weighted average lease term, 41 years. This is insane. Realty Income has like 8 to 10 years. Some companies have 11 years. Some companies have 15 years. But this one has 41 years in terms of lease terms. Very long-term leases. And it's very safe. It's not going anywhere. It's one of the safest REITs you could ever find. And the dividend is around 5.6%, which isn't too bad. And the company does grow the dividend around a 7% CAGR, which is much higher than other REITs. Realty Income grows it at 3%. VC is almost double that, around a 7% CAGR. So it's not only getting a good yield, but you're also getting some dividend growth, which is very important over the long term. But the problem with VC Properties is because it's such a safe company. It's very safe. It's so safe that it's priced accordingly. Everyone knows VC is safe, and that's why you're not getting such a discount whenever you're buying it, especially if you look at the average multiple or the mean multiple. The mean was 14 times, and now sitting at 13.44. So you're not getting much of a multiple expansion. But if you look at Realty Income, which has a little bit more risk, nothing crazy, a little bit more risk, Realty Income, the mean for it was 18 times, and now it's trading at 13 times. So with Realty Income, you're not only getting a dividend, you're not only getting some growth, but you're also getting the potential of a multiple expansion, which you're not getting right now with VC Properties. So with VC Properties, if we get the dividend of around 5.6%, which is not too bad, and you're getting around 4 to 5% AFFO per share growth, which is pretty much, you could say, like earnings per share, but for REITs, we use AFFO per share, same thing as EPS. So if we assume around an average of 4%, which isn't too bad, it used to grow much more, like 10, 11%. I wouldn't say that's sustainable. But assuming 4% and 5.5% dividend, this is like a 9.5 to 10% annual return for VC, which isn't really too bad at all for dividend investors. But for me personally, I like VC at a 6% dividend yield. If I can get it at a 6%, which I believe is below $28 per share. So if VC does go to $28 or below, the dividend will be pretty close to a 6%. This way, I would be getting a 6% dividend yield, and I would be getting the 4% AFFO per share growth, which is around 10% a year, and I could get the potential of some kind of a multiple expansion that could push up my returns to 12, 13%. This way, it would be worth it. So I like VC over here. It's very safe. It's not too bad at all. But for me, I would wait for a 6% dividend or $28 per share. And that was my quick review on all those three stocks. It wasn't financial advice, just my opinion. I hope you enjoyed them. If you want more of such stuff, let me know in the comments. Thank you again for watching, and I'll talk to you in another video.